welcome back to Upside Down Data. So today I want to talk about something a little bit different. So I'm going to talk about our risk indicator here at the channel, the upside downside potential indicator. And the way that we usually talk about this model is asset specific. So we'll choose an asset like I'm showing you here, the Bitcoin UDPI, for example. And when you look at it, this is the Bitcoin price color coded on the UDPI level. We've talked about this before a lot on this channel. You've been following it. The UDPI does a good job of identifying these high risk points and these lower risk points. So these good accumulation zones and also these good distribution zones as well. But one of the things that we haven't really looked at before on this channel is what happens if we look across assets. So instead of just looking at Bitcoin, just looking at Ethereum, etc., what happens if we take the UDPIs from all those different assets and actually average them together, basically make an aggregate sort of UDPI or an average UDPI? So that's what I want to talk about, because this is an exercise that I think is interesting and actually yields some pretty interesting results. So I'm going to flip over here to the average, in this case, long-term UDPI. So the long-term version of the UDPI, here's what moves that play out over multiple months. It's more macro in its focus. And basically what I'm showing you here is just for reference, I'm keeping the Bitcoin price here just because it's the asset that's been around the longest, Bitcoin being the first cryptocurrency in existence. It has the longest price history, etc. And then essentially what we're doing with this chart is that as any new asset came into existence, so for example, XRP, Litecoin, as they came into existence, coming up through here, then Ethereum coming into existence, etc., they just get added into the average. So at the very beginning here, this is just going to be Bitcoin and its UDPI level feeding into this because Bitcoin is the only one that existed. And then as assets came into existence and their UDPI readings came about, we're adding them into the average. So by the time we get up to here, we have many different assets UDPIs feeding into this aggregate. I think we're falling around 25 assets or so on the channel currently, or at least we have UDPIs tracking about 25 different assets currently. And so those are kind of getting added in as they existed. And so I think we can look at this a little bit better if we just look at the raw levels instead of looking at a color coding. So again, the Bitcoin price is just here for reference, so just so we can kind of see in the market cycle what's going on. But of course, the average UDPI level here is not just Bitcoin. It's Bitcoin plus, at the end here, 25 additional assets all feeding into this average level. But as I mentioned before, at the beginning here, it's just Bitcoin, because Bitcoin was the only asset that existed. Or at the very least, it's the only asset that we're tracking, that we have data for, that we're adding into the mix here. And when we look at it this way, I think some interesting patterns start to emerge. So first off, when we're just looking back here at this peak, this is just Bitcoin data going into it. So, this is just the Bitcoin UDPI more or less, basically. So, spiking up all the way to 5, up in this run and then coming down low. But as we start going through, more assets start getting added in. XRP and Litecoin get added in, and then Ethereum, and then, a bunch of those assets that came into existence in kind of this time in the market over here as well. Things like, ADA, Chainlink, some of those started coming to existence. And then the more, newer assets, things like, AVAX, Solana, Polkadot, things like that start coming into the equation more over here. So I think there's some interesting patterns that we can look at, though, just from looking at this. I think some interesting things that show up. So the first thing that's interesting is that it seems like when you're looking at a more aggregate form of the UDPI, especially as more and more assets get added into kind of the aggregation or the average, then the UDPI doesn't tend to get all the way up to this highest possible level of risk, 4 to 5. And this makes sense because, assets run at different times. They're going to have their peaks at different times in a market cycle. So, for example, Bitcoin had its peak in 2017, right here, and its UDPI would have topped out, up in this highest level of risk right about here. But a lot of altcoins didn't run until actually the beginning of 2018. So that's when you see this spike up here in the long-term UDPI showing up over on this side. It's because most assets that were around at that point didn't show that big spike until after Bitcoin put in its top. That's something to notice there as well. And then likewise throughout here, kind of this 2021, spring, a bunch of assets went parabolic, but they didn't do it all at once. Bitcoin kind of went on this big run first and had a second leg up. A bunch of other assets actually waited. Some of them ran, a month after Bitcoin. Some of them waited all the way until April or May to really start running. And so because of that, you'll have some assets cooling off on their risk while others are exploding. Probably partly why on average we only get up to around 3, because some are cooling off while other ones are rising. And so you're not going to get all of them up at the highest level of risk most likely. You're you're going to get them somewhere up here. But what this would mean, though, is that in the aggregate, if you get a UDPI rating at around 3, that's pretty darn high risk, right? Because things aren't all lined up, if you do end up getting to this point, it's still saying that overall the assets are quite overextended. They might not be all the way up at 4 on average, but that doesn't necessarily matter. They're so overextended, there's so much overheating in the market generally that the risk level is this high. It might suggest then that this is unsustainable. The same thing that shows up back here and shows up back here again. Now, one interesting thing that shows up on this average or aggregate UDPI is this spike here in the 2017 run that we're seeing here. And you might be asking, well, what's going on there, right? Bitcoin wasn't even, it was getting towards its top, but it wasn't really near its top yet at that point. Well, the reason why this happens is that a number of the assets that are in this aggregation at this point, XRP, Litecoin, and Ethereum, went on crazy runs in the spring into early summer of 2017. That was kind of that massive first impulse for those assets. So that's why we're seeing this here, that they really shot up on their risk level and then had to consolidate, had to cool off before they make their final push over here. That's what's showing up over here, just for context. But what I think is maybe most interesting about this exercise, if we look at what happened during this period here, coming out of the summer of 21 into the fall, look at how high the average UDPI got here. It's just a little bit below what was happening in the spring, right? It was all the way up, getting close to 3, actually basically the same level that acted as the tops in this double top kind of move in 2013, kind of on average of the assets that existed then. And that's interesting, right? Because a lot of models missed this completely. A lot of models that people were looking to tell them about risk in the market did not see this as being especially risky at all. It really didn't give any advance warning that a move to the downside could be that plausibly following. This model would have said that, right? And kind of ironically, we weren't looking at this back when this happened, but if we had, it probably would have been a good thing to watch, because this was actually kind of a canary in the coal mine that maybe things were getting overheated at that point in the crypto market. And it makes total sense when you think about it too, because a lot of the assets that we're following, made crazy runs during this time. ADA putting in its all-time high, Solana going nuts, AVAX going nuts, etc. That was all happening in this general period. So it makes sense that risk was getting elevated across those assets. And as we see, when that happens, when the average risk gets high, then big corrections to the downside can follow. Now, obviously, coming off of the spring of 21, we corrected, about 50% or so, then moved back to the upside. This has been a much more brutal bear market where we're seeing right now. So, but the idea is that, the market was getting overextended and downside was likely. And then what ended up happening is that now we can see that on aggregate, UDPI got all the way down to -4 on average across assets, which is roughly about the area that tends to act as kind of a bottoming point in bear markets. Now, I'm not going to call a bottom because of this by any means, but it is just notable that's where we're at. We're in a very nasty bear market right now, and on average, the UDPI is getting back down towards the levels that it's gotten to in previous bear market lows. So something that I think is just interesting there. And this doesn't just show up with a long-term UDPI either. So we have the medium-term UDPI that cares about moves that play out over weeks, so a little bit shorter in its time horizon. And we see a kind of similar pattern. But interestingly, if we look at what happened over here versus here, you'll notice that the medium-term UDPI actually got to the same level of risk as it did or in the fall of 21 as it did back in the spring of 21. And again, just acting as that canary in the coal mine, saying, hey, the market's getting really overextended right now, be careful. And it actually acted as a bit of a leading indicator here, spiking up, all the way back kind of here more in September, October, where assets like, ADA and some of those other ones, Solana, really were going nuts. And then spiking up again in November when Bitcoin put in its all-time high, and a few other, Ethereum did too. Some other ones ran later there as well, spiking up again to 2. But then you're really kind of moving back to the downside. And again, whenever we've gotten to these levels on the kind of aggregate UDPI, with the one exception being this peak here in 2017, usually some notable downside is followed. And so that would have again acted as some kind of a canary in the coal mine there. And then finally, if we look at the short-term UDPI, it again shows a similar type of behavior. And what's I think interesting about the short-term UDPI, kind of on average across assets, adding assets in as they came to existence, we can actually see that 3, it's actually acted as a pretty strong kind of resistance level throughout. So, getting Bitcoin got a bit above it on its own, back over here. But then really once assets started getting added into the average, around 3 is about as high as it's ever gotten. But then again, on the downside, around 4 is about as low as it gets as well. And so it didn't spike up quite as high, in this time here as it did back here. This big impulse here was a little bit higher, which in some ways makes sense because assets were, doing 10, 20 X's during this time and really exhausting their short-term potential. So it makes sense that it might have been more kind of cautious here, whereas here they were going nuts, but not to the same degree. That might be why it didn't get quite as overextended here, but it still was quite high, right? It was up at 2, and again, even at 2, that is historically been a pretty high risk level. And then even actually what's also I think interesting and notable is that back in kind of the spring of this year, it got all the way back above 1. Again, a pretty high risk rating. And so I think this is a useful exercise, right? I think this can tell us information that individual UDPIs don't tell us, because individual UDPIs are all just caring about the focal asset. They don't have that broader context. Whereas once you start aggregating over many different assets that are in the crypto space, you can get a better idea of what's going on overall. And it can tell some interesting pictures. And I think what this really would have, helped a lot with back in the fall of 21 is just telling us, hey, the market's getting pretty overextended right now. It's time to start getting cautious. And that would have been a very different narrative than you would have been hearing from most people in the crypto space at that point, who were expecting just a rip to the upside, going to 100K on Bitcoin and the rest of the market following along at that point. This model, this kind of aggregation of these models would have actually been saying, now hold on, the market's already getting overextended. So for Bitcoin to go on to 100K from here seems kind of implausible given how overextended the market already is, unless the crypto market would have just completely detached itself from anything it's done in the past and just gone, crazy and totally departed from history. Obviously now with hindsight, we know that didn't happen. And so I think that this can give kind of that advanced, potentially give us just a better sense of what's going on across the space. And if we're on a more macro perspective, getting overextended, or if we're, also likewise getting maybe oversold kind of to the downside. And all these different aggregations across the different time frames of the models are all telling a similar story in that dimension as well. So something I just wanted to mention, and this is something I think we're going to continue to watch, and certainly, in future kind of big moves, it'll be a useful tool to look at to get a broader perspective on the market rather than what we'd be able to get on just one asset on its own. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. A lot of updates, better indicators, and more over there.